to the Mint Asset Management update for the single sector funds in June, looking back at the month which was May. My name is John Middleton and I'll talk you through the fund performance. So I thought we'd start by looking at earnings worms. We looked at these a couple of months ago, and I thought I'd just give you an update post reporting season, essentially. Just a word of explanation. These are basically charts looking at earnings expectations for markets, in this case, the Australian market, over time. Essentially, we start with analyst expectations for earnings in January and track these through to December to give you the worm or the line. And generally, we start optimistic at the beginning of the year and then become a little bit more realistic going forward. The lines we're looking at are basically the light blue and the sort of yellowy orange towards the right of the chart, looking at 2025 and 2026 earnings expectations. And as you'll see, we left you in February with pretty low expectations or negative expectations for earnings in 2025 and 2026 earnings expectations for about 5% growth. And notwithstanding a little bit of an upgrade in February, we've essentially ended broadly where we started, with expectations for 5% going forward. And for me, this is probably a sign of improvement. Clearly, we've had a lot of Trump and tariff shenanigans in the last couple of months, which does impact Australia to a certain extent. But bear in mind that 2/3 of their market is basically banks and resources. Nevertheless, I think we are starting to get more realistic expectations about earnings going forward. And again, I still think that 2026 will be an up year versus 2025. But we'll come back to this a little bit later on when we look at the earnings composition of the Australian market. Anyway, moving on to the funds and starting with the NZSRI fund. Good month for the market and the funders as well. Always nice to see the index up 4.3%. In hindsight, actually, that was a little bit disappointing as mid-month, the NZX was up about 7%. During May, we did have quite a lot of information, a mini reporting season with 22 companies reporting, including most of the property sector and the likes of Fisher & Paykel Healthcare, Infratil, Mainfreight and Ryman. And as the table on the right demonstrates, I think it was a solid reporting season. Certainly, revenues were a little bit light, but underlying earnings, EBITDA and EBIT and EPS, I think were broadly in line with expectations, with similar upgrades to downgrades. But then when we start to look at the outer years, again, there were net downgrades. We're still expecting about 10% growth for the year ahead, in 2026. And that feels still a little bit optimistic. But again, I think we are firming up those expectations. And the good news is there were only minor changes in the reporting season we just had. Looking at the main results in that reporting season, and again, highlighting the fact that Mainfreight was a big contributor for us in the month. We talked about this a little bit at the end of last month, but the Mainfreight result was well received. They gave us a trading update ahead of the results, saying everything was fine, and actually the result was sort of classic Mainfreight. A solid performance, and again, Australia probably the standout, with sales up 17% and profit up 7%. So that meant that for the first time, Australia, in terms of profit, became bigger than New Zealand. And again, those two sort of regions continue to dominate. Europe was the only other region that delivered a profit growth year on year, with the US and Asia looking a little bit subdued. And again, where sort of warehousing was the area of the business that grew, with transport and air and ocean under a little bit of pressure. But for me, the result was classic Mainfreight. A good performance in what are challenging macro conditions, particularly in New Zealand at the moment. And again, I think they've sort of addressed issues and aligned the business, so they do expect better growth in the second half of the year and going forward. So just reinforcing it is a quality operator and remains a core holding. Elsewhere, I'd say the Infratil result was a little bit disappointing. Again, we got an update prior to the result with an investor day in Australia. And again, I think there was a little bit of slightly confused guidance from that. The result from CDC was considered disappointing. At the investor day, Infratil had talked about EBITDA doubling, which implied 660 million of profit going forward. But the guidance for FY26 was for 400 million. For me, this is just the scaling of the operation. I mean, again, by the year end, we could get to 600 total, but for the year as a whole, we're probably below that because we continue to build aggressively in that business. Long road again, probably slightly on the negative side. I mean, this is the area that is about green energy in the US and has been hit by sort of a little bit of tariff and a little bit of IRA unwind. So, again, I'd say the earnings there were solid, if not a massive driver of upgrades. Spark was again delivered One New Zealand gave a pretty solid performance, broadly flat year on year. Again, not seeing the same issues that Spark is currently feeling. And then probably the standout positive from the Infratil result was Gurin, the European green energy business, which is starting to get some quite substantial contracts in place, which will drive future revenue. So, Infratil mildly disappointing, but we sort of actually added to our position on weakness. And then the final stock to talk about in terms of earnings was probably Serco, where again, they delivered a slightly disappointing performance. The key thing was that they expect sales for 2026 to be sub 10%, which for a growth business is disappointing. But again, it is a travel-related business, and they are starting to see a bit of business travel hit by the ongoing uncertainties in the States, which is impacting their business. So overall, Serco was disappointing, and again, was probably the main negative from the month of May on performance. Finally, just in passing, would note that on the 29th of May, EBOS, or more correctly, Zulig, one of the major stakeholders in EBOS, sold 949 million of stock, or about 9% or 10% of their holding, to leave them with a residual stake of about 5%. They sold it at a decent discount to market, so about 9%, and we participated in the trade. And obviously, this was a reasonable slice of equity, which has gone from a static long-term holder to being held in the market in NZ and Aussie. It has driven an upweight in the New Zealand market weighting of EBOS. I think it will drive an ASX upweight as well, and probably drive further upweights in global indices for EBOS. So we saw that as a good move for the company structurally, and again participated in the sell down. Moving across to the Australasian Equities Fund, and again a good performance. Interesting, even sort of better in the sense that New Zealand was up 4.3%, but Australia was up 3.8%, and generally we'd expect the fund to lag a little bit in that context. But again, another strong month for a number of Aussie holdings. WiseTech up 21%, Megaport up 18%, SRG up 17%, and obviously Mainfreight up 21%. All helped the fund to deliver ahead of benchmark. The negatives were really Telex, which was off 4%, and Serco, as we've mentioned before, 17%. And again, I think Telex was more a little bit of profit taking ahead of an investor day in the next couple of days. So just focusing in on WiseTech, again, why was that up so much? Basically because it announced what looks to be a transformative acquisition. It's looking to buy E2open for $2.1 billion, and it's sort of looking to merge WiseTech's state-of-the-art sort of logistic software, which is really focused on the haulier side of things and sort of the export area of the market, with E2open, which has got some quite strong customer relationships, but also very good shipping container software, so more the C side of the market. And again, you're looking to combine two businesses to create a much better package and offering going forward. both businesses are highly complementary. To be honest, you've probably put in a bid and got it accepted at a very opportunistic price, looking at the E2 Open share price. And again, while we're just merging these businesses and getting earnings accretion in year one, clearly the opportunity is to leverage the two businesses together and create further earnings outperformance. So I think that market went down well in terms of the market reaction. And I would also flag that I think it did help in the sense that WiseTech has had a few issues, certainly with management and disclosure over the last few months. For me, this maybe explains a little bit about why the CEO was keen to stay, and again why certainly the new product rollout has been a little bit delayed if you've been talking through this acquisition in the background. Looking to the picture on the right, this is just dovetailing into the earnings worms. This is essentially how ASX 300 earnings expectations have changed since February. They're off about 3.5%, which is the yellow box, and downgrades across the board. The only sector that saw some positive earnings momentum was actually the telco sector. What has driven the main impact? Well, two sectors mainly. First of all, energy. Not a massive surprise with the change in the oil price there, but certainly the tech sort of movement requires a little bit of commentary, particularly as we've seen, technology names have been big contributors for us for the last couple of months. So why are the earnings down so aggressively? Yes, we have seen a few downgrades from the likes of Xero and WiseTech. What I say, these were quite minor in nature. What has brought the sector earnings down has actually been the smaller end of town. So we've had things like BrainChip and Novanix moving earnings into negative territory, and that's been the major impact on the earnings number, probably a little bit overstated. Finally, just in terms of moves within the fund, we've added Challenger. We hope that we're going to get a benefit going forward from Oz changes to capital ratios for annuities over the months ahead. So added to a bit of that and added a bit of infratil weakness. Then finally moving across to the property fund. Again, good month for the sector again, and the fund sort of broadly kept track. We got what I term a solid reporting season from a number of the Kiwi names, and then a bit of an unexpected gift out of the budget, one of the few gifts that were given, to be perfectly honest, and that was the investment boost. So essentially we're getting an upfront tax benefit for 20% of new capital spend going forward, and those essentially building new warehouses and product will be able to get a benefit from that going forward. I would say there were probably three key messages from the reporting season, confirming what we talked about before, really. First of all, I think earnings are stabilised for NZ and across the board. We are getting solid rental growth in most markets, most notably probably in office and retail, which were the sectors which were under sector. But the reality is that this top line revenue growth is still being offset by increasing in interest payments, whether that be through rising debt or interest rates continuing to move up. But I think that trend is probably coming to an end, and net, while we don't expect much earnings growth for the next year or two, I think thereafter we should start to see earnings growth coming through. Second point would be dividends, and again we've majored on this and flag it in the chart on the right, which I'll come to, but dividends were held in line with expectations, so I think cuts are gone. Yes, some of the payouts remain stretched, certainly for the time being, and I think will remain so in the year ahead, particularly at the smaller end of town. But I think management has made that consistent promise that we're not going to cut dividends from here, and I think they do stay flat at current levels for the next year or two. And then finally, I would flag that I think we are getting a firming of asset valuations again across the board. I was a little bit surprised to see Argosy asset values increase, but I think certainly the mark to markets on office and industrial and retail are pretty much coming to an end. And again, I wouldn't expect to see major movements in asset values going forward. And then finally, the chart on the right just sort of hammers the theme we've been sort of saying recently. Property yields are attractive, particularly with their sort of tax shield element to them. They are amongst the best in the market. Yes, you can get, the telco sector and others paying yields of the same extent, but I think there is a little bit of risk there. And then the other thing I would flag is that, relative to history, the power generation sector or gentailer sector, which is the dark blue at the bottom, is not offering the yield that it has done in the past because of share price strength. So for me, I think the fact that the property yields are high and sustainable, has made the sector attractive, and that is part of the reason they had a very good month of May. Anyway, hope that was of help. If you have any questions, please drop us a line at info@mintasset.co.nz. We appreciate your support, and I look forward to talking to you in a month or so.